The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder and editor of The Intelligent Investor, and I have with me here this morning James Carlisle to talk about three of the top 10 growth stocks we have before us today. Welcome, James.
Hello.
So I think we're going to kick off today, James, with a company that's very familiar to you. I think the first time you started looking at this company was in about 2014. Is that right? Altium?
Yeah, that is right, actually. I looked at it in 2014 and it was just going through a major sort of restructuring with the current chief executive, Aram Mirkazemi, in charge, and really setting out on its growth path. And the market was sort of aware of this, had it on a huge PE, I don't know, probably 30 or 40 at that time.
It sounded huge at the time, not so
well,
much
that's
now.
right. That's right. And I mean, that's about what it's on now, right? So, and, you know, I thought, look, this looks like a fabulous company. But, there was also in the back of my mind that little sort of Aussie company trying to conquer the world, and they had a bad track record at that at the time. There's been a few that have managed it since. Yeah. So it looked too expensive at the time. Yeah.
So it's back on the buy list now. Let's kick things off by talking about what Altium does, because it's quite an ambitious and unusual business in terms of what it's integrating. So do you want to explain what the company does and how that relates to printed circuit boards, which is the area in which it functions?
Yeah, so it basically makes the software that people use, designers use to design printed circuit boards. So the printed circuit boards are the sort of green or sometimes brown, sometimes red plastic boards you see in pretty much all electronic equipment, onto which get placed the resistors, the capacitors, the silicon chips. Various of them actually get built into the board. Somehow, I'm afraid that the technicalities escape me, but are beyond me, I should say. And so, they can be in sort of 2D or 3D. You can have layered boards. So a combination of boards go into electronic products.
Right. So it sounds as though this is a long way from the old days in the 80s and 90s when you could take the back off a computer and pull a PC board out and put a new one in. It's a very different thing now.
Those are, PCBs are getting more sophisticated all the time. Manufacturing technologies enabling, better boards and you're getting bigger chips to go into them and all that. But the principle is essentially the same. You've got a bunch of components which you're connecting together, and you need, some sort of software to help you design that board so you can, figure out how everything fits together, essentially.
And I suppose that miniaturization is something that's driving this. So if you think, you and I both have Apple Watches, there's presumably a PCB inside the watch, and the size constraints are just almost impossible to work with. So because a lot of the devices these days are becoming smaller and smaller, and I suppose there's an efficiency element to this as well. If you make them smaller, then it becomes kind of more efficient. The design itself is a high-tech thing in itself. It's a very skilled part of the engineering process.
Well, the design, there's a couple of elements in that. The design gets more and more sophisticated, that's right, but also in terms of the components you can use. As you get smaller, you've got to be more careful about heat dissipation. You've got certain components will or won't work very well together. And actually the physical size of the thing, the physical shape of the thing matters as well. So, an example they often throw out is the Fitbit, in fact, not so much the Apple Watch, although I'm sure the principles are the same, because it's curved around your wrist. And so the point about that is that the PCB designers have to work with the product designers in order to get the thing in the right shape to fit in. I mean, as you say, back in the 80s when you had a computer, you just made your board and the box was always big enough to throw the board into it. But now things, the mechanical form of things is much more important. And so the software, the PCB designers have to work much more closely with the product designers and with the suppliers of the components. So when you're designing the board, and I mean, we're probably getting ahead of ourselves now, but one of the benefits of Altium software, their new Altium 365 cloud software, is that you can see in real time the availability of different components. So when you're designing a board, you can see, I can use one of those in there, and then you see that it's not available at the moment. It's going to be 6 months, and that's a particular problem at the moment, of course. Yeah. And so you say, I can make it with 2 of those instead, or however it is, one of those from a different. So
this is an important thing to understand about this business, by the looks of it, is that it brings three kind of elements together, which is the design of the board, the procurement of the parts. So there's all sorts of parts manufacturers, and Altium has a database effectively of different parts manufacturers.
Yeah, it owns
and
a
then there's the
company,
and then there's the final manufacturing and integration of the PCB itself. So there's 3 parts to this, and Altium 365 brings all of those together. So it sounds as though it's trying to be a platform business. Is that right?
Absolutely right. It's the future it sees is, I mean, it's careful about how it describes this. Sometimes it's careful, sometimes it's not. It says it has aspirations of becoming like the Adobe Acrobat for, as that is for PDFs, so that everybody uses it. Everyone knows how to use it. It's the industry standard. And the way of getting to that point is becoming, it aims to be so useful to people, through bringing everyone together. Its competitors can't bring everyone together in quite the same way. The product designers, the parts suppliers and all that. It doesn't have that. They don't have that cloud functionality at the moment. Meg Zimi said that he thinks they're 3 years ahead of the competition in terms of that. And 3 years in this business is light years. So it's performing very well, and especially at the moment, gaining subscribers. It went through a slightly difficult time during the pandemic, but seems to be firing on all cylinders now. And the idea is, as you say, that eventually it gets into that platform position where, if you want your product designers to be able to, mechanical designers to be able to sort of work with the PCB designers, then you really need to have the product hosted in Altium 365.
Yeah.
And that'll make it easier to sell. At the moment, you see, it's not necessarily charging for Altium 365, but it's, just that extra usability is driving sales of the core software product. But in time, it'll I think directly monetize the whole package.
It sounds we had a bit of history with a company called Infomedia, which was essentially a car parts database, and it seems as though there's a kind of parallel here. So you have previous to Altium, there was presumably individual businesses would have their own PCB engineers, and then they would have their own database of parts, which probably wasn't comprehensive, and you had to make all these calls to find out whether they're available and whether they'd fit. And it'll be a big hassle. What Altium does is bring those two things together in one piece of software. That's Altium 365. Is that right?
Yeah, that's right. So you could have there are other electronic component catalogs, but the one that Altium owns, it bought a few years ago, Octopart, it actually integrates into its software, so you can see in real time, and that's the huge advantage without having to go to a sort of separate product and see is that available. what happens is I believe, as I'm I don't pay the $7,000 or whatever a year to use this thing, but what happens if you try and put a component into your PCB that isn't available, you get a sort of red flag. It'll show as unavailable, and or you can check it's available, so you can check for alternatives, and so it's nicely sort of built into that to the core software.
Okay, so when you first looked at this business, it had a market share of about 15%. What do you estimate it is now? Because it's certainly a lot bigger. Earnings have risen six times. I think share price is probably up tenfold. That must be they must have a much bigger market share nowadays.
Yeah, so the roots of the company are in the sort of smaller user. So they've always had a lot of users, but less, the sort of student engineers and that sort of thing. Those that are going way back. So they've always had a lot of users, but not necessarily priced as high as some of the competition. So the competition has higher ARPU, revenues per user and all that, and in the past have had a more sophisticated product. But Altium's really caught them up with that. So now you've got this thing. And the advantage in that is that a lot of PCB designers, far more PCB designers will be familiar with the Altium sort of software and how to use it and how it looks and all that than will be familiar with some of the big competitors like Cadence and Mentor are the two big competitors. So having said all that, it actually became the market leader a few years ago, 2 or 3 years ago, I think, in terms of subscriber numbers. But it's still a little bit short at around 25% in terms of revenue of the market share, revenue market share. But it unlike the others, it's really on an upward trajectory. The others are sort of flattening off, and its market share is growing, and on a trajectory really to pass Mentor, which is the leader. It's a couple of percent short at the moment, but I think it's certainly expected to get there in the next couple of years.
Okay, so it's proving itself. I do remember some reviews that you've written on this business where you had some reservations about the management. You want to just address those? I think very salesy orientation.
Yeah, they're very effusive, shall we say?
Right.
An unfair way to put it would be to say they gild the lily. I mean, they're very enthusiastic. They love their company. They love what they're doing. They have big ambitions, and that comes through sometimes in some of the language they use. Some of their updates, you'd be forgiven for feeling there was a bit of hubris in there. But this is, I sometimes feel that's what you need to, these sort of, Moghazim is not the founder, but he's the founder of a company they bought, which is how he came into the company.
Yeah.
And, he has that sort of mindset, and he's very energetic, and he's driving this huge change in the company and in the industry. And I think sometimes you need that enthusiasm, and a byproduct of that is perhaps the way they talk to the market. I mean, they prefer talking to their customers and the industry, and so that requires a certain type of language. And some companies use a different type of language when they talk to the market, and the share market. That is, Altium perhaps not so much. And look, I don't mind that. I suppose it's a little bit unsettling at times, but I think you've got to understand where it comes from. Yeah,
it's a fine line. I mean, this is a guy who turned up in Australia from Iran in the 80s, I think you said.
Yeah, and, something like that, yeah.
Couldn't speak a word of English and enrolled in a University of Tasmania engineering degree 6 weeks after arrival. And I think you said in one of your original reviews, he didn't understand a word that the lecturer was saying, but just tried to work out what was being designed just by what was on the screen.
I think that's one of the reasons he chose, engineering as his because the language is more visual, more conceptual, and so he might have done other things, but he got into that, and clearly did very well. He's a smart guy.
And there is some. We look for founders or owners with a decent sized interest in the business. I think the difference between now and when you first wrote the company up, when you first looked at it in 2014, is that there's some proof there that ambition and that kind of aggression that you saw in his commentary has been matched by a massive increase in the value of the business and the size of the business. So the aim, I think, is to double subscription numbers to about over 100,000 by 2025 and get revenue.
2026 now, I think they've sort of let us. Yeah, they sort of let us every year. Yeah.
Okay.
And revenue. Sorry, you were going to say up to 500 million. Yeah. Which are they're big targets, and not many companies have the courage to sort of put those sort of targets out there.
Yeah.
And the problem is that then the market holds them to it, and the moment it looks like they might sort of defer that target, everyone gets upset with them. But these are targets; they're not guidance, they're not forecasts. They're just sort of saying where they aim to be. They want to be at those numbers. In order to drive through the change that they want to produce in the industry, in terms of bringing everyone together and making the whole industry more efficient.
And this isn't necessarily about the revenue or the EBIT that they're delivering. If you could see them expanding to 450 million and getting 90,000 subscribers by 2026, that'd be fine. That'd be quite good, right?
Yeah, that would be fine. And I mean, so long as the their overall plan. I mean, the reason we like the stock is because we see PCBs, electronics, as being a long-term growth market. We think that our lives are going to be filled with more and more electronic products as time goes on. And we think that they've got a very good shot at getting themselves into a position where pretty much everyone's using them to design the electronic guts of these products. Now, that's a huge opportunity. So what matters is that they're on track to deliver on that opportunity far more than any particular revenue or subscriber numbers.
That's right. This is about, can you see the platform becoming a platform? Can you see this emerging into a monopoly position where almost everybody in industry is using it? And whether that takes 5 years or 10 years, I mean, it matters to the valuation, but it's if they can stretch ahead of the competition and get to a point where they are the monopoly supplier to this industry, this would be an exceptional business with global. Yeah,
I mean, that's not going to happen in 5 years. The 5-year targets are really what they're saying is for them to be on track to be achieving this. Really the sort of full platform position, probably won't be seen for 10, 15 years. But I think that in 5 years, you'll get a very good look at whether they're going to achieve it. And that's what those targets are about. I think that management thinks it'll be hard to be doing what they want to be doing without those numbers, I suppose, is how you'd look at it.
What's the competitive response to their ambitions now, do you think? I mean, the competitors have seen their market share either be static or, in the case of, I can't forget which company it is now, but actually fall. They're clearly taking market share off Mentor, I think.
Yeah,
What's in their response?
Well, I think that you see a lot of the bigger competitors are actually focused on other areas. They're more interested in actually chip design and other areas, systems on chips and that sort of thing. And so this is actually a relatively small part of the business. I mean, Mentor is owned by Siemens. Siemens has got an awful lot of other things going on. Yeah. Autodesk, which tried to take them over, is another perhaps example. Which they make design software in so many different areas. They're an absolute giant, making CAD and other design software, and they wanted to plug this into their sort of overall offering. But really, I don't think they had. Well, I think probably I'm guessing here, but I think that they saw the cloud technology and they wanted to use that with all their other offerings, and they wanted to take advantage of the lead that Altium have got with that. Look, the competitor response that doesn't. I look at, no doubt they're all working on this, but as I say, Mogazimi believes that Altium's 3 years ahead, and that's a long way.
Yeah, and if you've got competitors who are also doing other stuff, that's a good thing for Altium, right?
Yeah, that's right. And the market share, as I say, I think an article, I think it was probably the interim result article in February this year, just had a graphic in it showing that Altium's, it came from their presentation, so it's in there, but showing that their market share is still growing while everyone else is kind of stagnating. I mean, remember also that this is an underlying growth market. So everyone's growing revenues, but some faster than others. Yeah.
Okay, so this is on the buy list right now. It's a buy below $30, I think. And now it's $28.46. So it's nice to have such a good quality company with such good growth prospects, global growth prospects at an attractive price right now. You own this stock, don't you, James?
Yes, I do. Yep.
Very committed.
And I mean, plan to keep owning it for a while. I think it's a good opportunity below $30. I mean, the thing to remember is that it's still on a very high price-earnings ratio. So for this year's earnings, it's around 55 times earnings. But those are very clean earnings. It expenses all its research and development through the P&L. And it's growing very quickly. So, I mean, the point is that I think it's a great opportunity, but, when it's subject to the whims of, the market in the short term as to how the market chooses to price that opportunity, that growth. I'm happy to take a long-term view, but I suppose it's a, buy in stages situation that cheaper it gets, the better the opportunity.
It does seem the kind of company where if earnings did disappoint, then in this market they could get hit quite heavily. And probably
absolutely, and they did during the pandemic. They so they were down to $23 at one point. They were down to $25 only a couple of weeks ago. So
right. Okay, then. Well, let's now move on to another software business. Not quite the same. It's kind of the opposite of a platform business, really. But TechnologyOne has a very unique kind of approach to particular market segments. Do you want to explain to us what TechnologyOne does?
Yeah, I wouldn't say it's that different. I would say that it is in some respects a platform business. But perhaps we'll come back to that once we've sort of talked about what it does. So it makes enterprise software, the sort of core software that runs an institution, the back office software, if you like. But the key difference with it and the competitors is there are some giant competitors in the world making this sort of thing, Oracle, SAP, to start with. But what TechnologyOne does differently is that it makes the one product for all its clients. It makes the same product. You get this product, you sign up, and you get the same product as Joe down the road. Now, other people's products are slightly different for a different industry, or they demand some sort of customization. And so that means two things in terms of TechnologyOne. It means, first of all, they have huge economies of scale because they're able to derive, I mean, despite being much smaller than some of its huge competitors, because it can focus all of its research and development into the one line of code, as they say. That's in the name, TechnologyOne. That's their one line of code.
Yeah. They'll actually have this motto, which is I think it's the title of a Bryce Courtney book, The Power of One. The Power of One,
that's right. And there really is a power in that. And that, I mean, software in many respects is a scale business. And we'll talk about that a bit more in due course with Xero as well. So it has all those scale advantages from the single line of code. But it also means that it's only really suitable to certain markets.
Yeah.
So markets where the customers don't really want to differentiate themselves according to the software they use. Mm-hmm. So, if CBA is never going to use TechnologyOne because, as far as it's concerned, their competitive advantage over NAB and ANZ is all down to their back office systems. I mean, that's what they do. It's integral to them, and they're big enough that really it makes sense for them to spend the money doing that. So for smaller organizations that really differentiate themselves on other things, and the most obvious would be so government, local authorities use TechnologyOne, and education, universities, and healthcare. So these are, a hospital is very happy to use whatever, it does not want to spend its life thinking about its back-end systems. It wants to spend its life thinking about how to, save people's lives. So it's happy to have something working in the background that just works, that it gets sent upgrades every 6 months, and they're ready to go the next day, and everything looks seamless. And if it sees that it wants to use another package, add another module to what it's paying for, it can do that, without having to go through some big integration. It can just sort of turn it on, and it all looks the same.
So this is a really important point, I think, to understand about this business, is that it's often seen as a weakness. This is off-the-shelf software. So what they're really saying to their customers is, we're not going to give you any customization. You can come to us and ask for special things for you, but we're not going to do it. What we can do, because we don't do that, is give you something that we have a very high confidence that will work, that will meet your needs, and will not require much maintenance at all. You can just turn it on, get it going, and then we can walk away and probably don't have to come back. There's a lot of advantages for businesses that are happy not to have customization as long as the basic functionality works. Is that where they set themselves apart from the bigger software, the bigger sort of oracles of the world?
Yeah, absolutely.
That advantage. Yeah,
that's exactly it. Yeah.
Okay, so they've turned what looks like a negative into a positive. But it's not custom.
That's right, but it's only for certain areas of the market, and this, I suppose, was my concern a few years back when I looked at the stock. I've looked at it occasionally over the years. And I've been concerned that it may be running out of market. Once it's signed up so many, universities and so many hospitals and so many local authorities, where does it go? And so it has to push into other markets, and it has to push overseas. But recently, I'm becoming more comfortable with. I've changed my view on that, really, because what is increasingly obvious to me, and also with other sort of software, other leading software companies, I suppose, like Xero, is that they actually create their own demand. So it's not, they don't necessarily, even if they had just the same number of customers, even if they don't increase customer numbers, they can increase what they sell to those customers by improving the technology, research and development, and they're in an incredible, and this is where the platform part of it comes in, they're in an incredibly powerful position to solve problems for their customers. So if you're a university or a local authority, is probably the better example, using TechnologyOne, you're paying them so much at the moment, but TechnologyOne can create new features which you can either buy or not buy. And if they add sufficient value, then you buy them. And so, over time, they used an example in their recent results, and I forget what it is, but of a customer going on a journey from, a few tens of thousands of revenue a year, 10, 15 years ago, and is now paying them $3 million or something. And so the point is that they can create their own demand just by making the product better. And there are ways. So something that's been happening particularly at the moment is their shift to the cloud. So everything's shifting onto the cloud. And what they find is that the average user uses 5 modules, but when it's on the cloud, they use 7 modules. So, immediately, just because of the more efficient delivery and the cloud product, that's where, so they can have, I think the way they run it is that they have everything running in the background. So a user can actually just start using a piece of the, one of the modules that it's not paying for. They can actually start using it. And the salesman will call them up in a few weeks after that and say, we noticed you've been using this module, and so how about you start paying for it? Yeah. That's incredibly powerful. So people, but it can only happen on the cloud. So that hasn't been, previously, if you want a new module, you have to sort of send off for the CD.
It's good to think about this, I think, in terms of almost like a consumer product. So everybody accesses it through the cloud. Each year or every 6 months or 12 months, there's an upgrade. Yeah, there's an upgrade to the software, and everybody gets the same additional features, and some are charged for and some aren't. Yeah. If you think about it in that kind of model as a consumer model delivered, over the internet, it's a very simple thing to do, and everybody gets all the additional functionality. If they pay for some and not others, that's fine. Very different from what Workaday or SAP might do, where you go to talk to a particular customer, they have a particular need, and then you write some code and that upgrade goes only to them. So it's a very different model. It's much more consumer orientated in the way it's structured, but you can see the advantage of it. One of the things that does interest me, though, is that they focused on this government kind of market, institutional market. They opened their UK office in 2006, but they're finally getting traction in that sector after being there for decades. No, it's taken them a while. It takes a while to get companies to build, or get all institutions to not just get the confidence to swap, but to actually swap.
But that's a lot easier, isn't it, on the cloud? So instead of having to send off, to get the CDs and to install them and to not be sure how it all works, to switch on to something on the cloud and know you're going to get 6 monthly updates just like that. It's a much easier sell. And so they're beginning to get traction over there in the local authority market. And they've recently made an acquisition, and I cannot remember its name, in the education sector.
Sentia,
sort of student. What's that? Sorry?
Sentia, was it?
Yeah, that's right. Yeah. So student management. Scientia, yeah, and that gives them a huge bunch of customers. So they can go now to all those customers and say, we see you're using this. How about I'm using the full package? So I think that, and they're doing what they do when they make an acquisition is they immediately release it. They all build it in to the product. And then the core product, and then they will spend the next 2-3 years. They take their time. They've got to get it right to actually build it into that single line of code, so it'll become absorbed. That's what they've always done. So over time, that'll be sucked in. But in the short term, it provides them with a whole bunch of universities to go and sell to. And the other part, I just want to go back to this increasing value point, because there's something that they're very excited about at the moment. They keep mentioning, which is called DXP, they call it.
Digital user experience.
Digital experience, I think that's the X. User experience. Yeah, platform is the P, I think. But the idea is that that the enterprise software extends from being a back-end product to being a front-end product, essentially, so that ratepayers in a local authority can access it. So you can, at the moment, when a local authority might have a big manual, hundreds of pages thick, where people call up and the person sitting on the end of the phone, when do the bins go out, and can I book a council pickup or whatever? And all of that, there's someone sitting on there leafing through saying, "Oh, you're on Wednesdays, or I'll book you in for this." Hugely inefficient process by which all this gets done. And the idea is that they're going to extend the enterprise, through a website, through mobile apps to the user. So you can have you can have your local government app on your phone and go through there to book a particular cleanup or to pay your rates or to do, all the different interactions you might do with your council or which a student might do with its university.
I would say that seems like quite a good area because governments and educational institutions are just usually terrible at delivering decent user experience to their end user customers. All of their systems are built with this internal perspective, which tends to be bureaucratic and awkward, and we all know that from using government websites. So the expectations when you go onto a public sector website are very, very low. If they can even get that half right, I think that would be a massive improvement in user experience. You don't need to be an Apple or a Google to do this well. You just need to be a lot better than what's currently there, and what's currently there is terrible.
But that's great for the ratepayers and the students. But
that's
sorry,
right.
go on.
It's great.
But also it's a huge money saver for the local councils and for the universities because they don't have to have someone sitting there with a huge manual, which they have to keep updating and printing off. And you first of all have a digital manual and you have it all automated, so people can go in there and sort themselves out.
That's right.
So this is how they've got that platform, which they can continue to. By which they can add more and more value, and by which more people can, will provide them with revenue growth, even in the absence of new customers. And then you add new customers onto that, and the whole thing, grows that much quicker.
The other aspect to this, I suppose, is that, and I don't know whether this is correct, I'm just guessing, but from what I know, I've got a friend who works in local government and he heads the RT department at a local council, and he gives me the impression that the market in software to manage like a local council is quite a complicated and congested sort of bureaucracy, and the software that they use to run that congested bureaucracy often comes from lots of small individual suppliers, and his job is largely knitting these things together. So it makes me think that there are companies who solve particular problems within these institutions. But what TechnologyOne does is provide a holistic approach and a rounded approach. But does that mean there are acquisition opportunities within this sector that TechnologyOne might undertake to build out the scope of their modules? Yeah,
absolutely. I think that they make piecemeal acquisitions, and Scientia would be an example of that. But it's a question for them whether they want to develop it themselves or whether it'd be quicker to buy something to integrate. But okay. That's a great example what you just gave there of what they're trying to do. So they really would like to put your maid out of work. That's the essence of it. They
I think you'd be quite grateful of that too.
they freely admit that they're not the best in class of every single area that their software covers. But what they say is that the real trick here is to bring it all together into one product and to make it user-friendly in terms of that. So when you go from one product to the next or one module to the next, it works in the same, you get the same user experience. So you know how to use it instinctively rather than going from one product to someone else's product. And everything looks different and the functionality is different and they don't connect particularly well.
Yep. Okay, let's talk about valuation then, James, because I don't think this company has ever been on the buy list, has it?
No, it hasn't. It keeps being too expensive. We are getting closer. We were getting closer. It dipped below. So I wrote it up last month and I sort of suggested about $9 for the buy price. And we're still sort of waiting for that, although it's now bounced. It got below 10. I should disclose I actually bought some for myself, just a small starting position because I couldn't help myself. But the way we work things is that we want a consensus amongst the team before upgrading, and the general view is we'd rather $9, and I think that's fair for a full-on buy recommendation. I'd want to see $9 too, but we're getting the message is that we're sort of getting close to that, or we were below $10 at $11, not so much. But look, $9, $10, $11. If you believe the story, it's an attractive company. So that's the view I sort of took. I was prepared to buy a small sort of starter position. I mean, it is expensive though. It's a similar sort of price to Altium. It's a current year PER of 42. So a little bit cheaper, but it doesn't expense. Well, it capitalizes around half its R&D. But so the historical growth has been about 15% a year, and they pretty much manage the business to achieve that. I mean that sounds, I don't like companies that manage themselves to achieve certain rates, but that's what they're trying to work. They have a sort of methodical approach to approaching customers, and it takes time and so
there's a good lock-in on the revenue stream as well with the customers they've already got. Right. Then they're not going to change in and out quickly.
No, their churn is microscopic. I mean, 1% or something tiny. So they've been growing 15% a year historically, which is doubling every 5 years. So that P of 42 would come down to 21 over 5 years. And if you think it's going to be on a P of 42 in 5 years, then you might think that you get a 15% share price return over that period. Right. But that's a big ask. And I suppose the point is, I mean, I'm more comfortable now with that continued growth. It's not so much that so a few years ago, I was happy to imagine it was going to grow at 15% a year for a few years. Now, I suppose the difference is that I see it that 15% a year carrying on for more than a few years, more like 10, 15, 20 years. And that makes a big difference to the valuation.
So they've expanded into the UK. That seems to be getting some traction now after many years of working away at it. It shows that you need to be in a market, I think, for a long time before you start to get any traction. Are they moving offshore anywhere else?
Not really, no. But Australia is ANZ, I should say. So they've got a bit in New Zealand. But I think, every now and again you hear a mention of the US, and I think they will go there eventually. But they're not there yet. I guess they want to have that, a certain amount of scale before they get into there. Maybe it wakes up the dragons as well. Maybe, at the moment they're sort of building their businesses quite nicely and slowly. But, you get into America and then the Oracles and the SAPs start to pay a bit more attention.
Well, that's a nice segue into our third business, which we actually discussed in detail in StockTake podcast a couple of weeks ago, and that company is called Xero, which everybody knows. You've had a good look at this over a number of years, James. It went into the US,
definitely woke the dragon,
and it did wake the dragon. And the company seems to have done pretty well in the UK. Xero's done very well in Australia and New Zealand. If you were TechnologyOne, you'd probably be taking a good look at the Xero experience, I think. I know it's a very different market. It's a more consumer-orientated market, but the US seems to be a different kind of place, and it's harder to expand into the US because it just seems to be either have more entrenched, more powerful competition or more diverse competition, or maybe a combination of both. Whereas somewhere like the UK, South Africa, which Xero has also done quite well in, doesn't seem to have the same kind of. There are more competitive openings there, I think, than in the US. So let's just talk about Xero in that sense. It's a very expensive business. It's growing quite rapidly. How do you see where it's situated now?
Oh, well, that's a lot in that. But I think the thing with the US is that it's a bit skeptical, a bit more skeptical. In America and in the UK, people are very used to using overseas sort of products, very used to using American companies, for example, particularly for various things, particularly technology.
Are you accusing the US of being parochial, James?
Yeah, well, I am. Yeah, that's exactly what I'm accusing them of. But with good reason, because a lot of the big tech stocks are US companies, and so I think people are used to using homegrown solutions. And so when some ringing comes from Australia or indeed the UK or Europe or whatever, they're a little bit more skeptical of it. And so Xero has been finding the going a bit tough there. But most of all, it's that dragon which has been woken up into it. So with its QuickBooks product, and they, to be fair to them, have done a great job of producing their own cloud accounting product. And it, that was really Xero's big competitive advantage. And in Australia and New Zealand, they got enough market share before the competition sort of woke up and had its own equivalent. But in the US, they never quite got there. They entered the US before I suppose you can't have that market share, but before they had that sort of that strong, powerful economies of scale, they were still not making money. And so there's limits to how much they can spend. Intuit have certainly outspent them the last few years. In terms of marketing and in terms of R&D. So you've got this situation now where they're finding customer acquisition. They're still growing in Australia and New Zealand, but that's likely to slow. They're well over 50% market share now. And cloud penetration in Australia and New Zealand is much higher than it is in the US. So that... there are beginning to be limits to what they can do here. In the UK, they've got competition from Sage, and they're going pretty well, but it's kind of an even fight with Sage over there. And so customer acquisition getting harder. And in the US, it's not so much getting harder, but getting more expensive. There's still an awful lot of customers over there, but they're having to spend more to get them. So it's getting to be, and I think it's increasingly going to be the next 5 or 10 years, a harder slog to grow their subscriber numbers. Now, against that, you have this situation whereby, and we talked a moment ago with TechnologyOne, they have this platform, and to some extent, they're masters of their own destiny because they can increase the revenue they get from their existing customers by just improving their own core product and charging more for it. There's a lot of pricing power. I mean, they charge $30 a month is the ARPU for this thing, and you can certainly charge. The actual value it delivers is way in excess of that. But they've also got. So they operate as a platform for all kinds of other little accounting add-ons for different industries and for different tax situations and all kinds of things. I couldn't even name them all. I think they've got more than 1,000 apps, I think, in what they've now created as the Xero App Store. And they'll be taking, I think it's 15%. Essentially commission on apps that they sell through the Xero App Store made by others which work with the Xero platform. So a little bit like TechnologyOne, they have that opportunity to keep adding value to their existing customers and keep growing revenue. So the last 5-10 years have all been about subscriber growth. And I think probably, to answer your question, finally, about where they're at, the next 5-10 years, subscriber growth will be ticking along, but the greater interest now is to see what they can do to grow revenue per user and how much value they can extract from the subscribers they've got. Plus, of course, then you've got the possibility of an improved performance in the US, although there's no particular sign of that at the moment. They're just sort of plugging away over there, really.
Well, they've just changed how they sell over there, by the looks of it.
Yeah, they're shifting. Well, I think I'm not quite sure. I mean, they're gradually shifting, I think, more towards the partner model that they've used successfully over here. But everyone's doing that now in some way or other, offering incentives to accountants to get all their clients on the platform. And you see, that's a much easier sell when you're, in Australia, if an accountant says, look, I want you to go on Xero because it's going to be much better for both of us, you're going to say, well, fine, there's no problem with that. We know what Xero is, and all my friends tell me it's the best. But in the US, if your accountant comes to you and says, I want you to get on this little Aussie company called Xero, which you've never heard of, you're going to say, well, look, I was very happy with QuickBooks, thanks. So I think that partner-led model works better where you have the dominant cloud product. Where you don't, I'm not sure it's quite so easy.
Yeah, so I think in your last review, James, you sort of outlined 3 different scenarios for Xero. There was a bullish and a sort of middle case and a bearish. And the bearish view had 15% revenue growth. And at that rate, then your return over, well, you can see the scenarios in the last review. I think that's the best way of explaining it. But it does seem as though this business is, it's at a, would you call it an inflection point? It does seem to be at a point where they've had that move to the cloud. They were the first mover there. They grew astronomically quickly. Now the competition has moved to the cloud. They've taken away that reason for people signing up for Xero. So they're now building out this platform with loads of plugins to try and expand the quality of the user experience, which makes a lot of sense. But it does seem as though the growth is kind of cooled, and it's harder to get. They're spending more to acquire customers. Under those kind of scenarios, how do you feel the company will fare over the next few years?
Well, I think that's exactly right. They've been growing subscribers very quickly, and in some respects, how quickly you grow subscribers depends on how quickly you grow your revenue per user. So if you put your prices up, you're going to grow your customers less quickly. So those two factors both go into the revenue growth, and I think what we've seen in the past is that the revenue growth mostly been driven by subscriber growth. I think the next 10 years, it's going to be increasingly driven by the revenue per user growth. So I think subscriber growth is going to cool in Australia and New Zealand because they're reaching, saturation points. And in the US, well, the problem they got in the US is if they put prices up, then it's going to slow the growth. And so they're a bit caught between a rock and a hard place. But I suppose, at a price of around $80, what I reckoned was, and look, this valuation is hugely difficult because it's so uncertain how things are going to pan out. The reason I put that,
as if you're talking about 2 different kinds of businesses.
What, in the US and in Australia and New Zealand? Yeah, I think that's right. Yeah. I mean, they're very different stages of you've got one market leader and one barely even up and comer. I mean, it's tiny in comparison to Intuit. So very different businesses, but they're being run, together, obviously. And I mean, I think it does make sense for them to be in the US because they're spending all this money already on the core product. It comes back to this economies of scale thing. It is a scale business. So if they're having to spend all that money to develop the product, they may as well be selling it in America. But I think our hopes for what might be achieved over there have to be reined in a little bit. But it all creates huge uncertainty over the valuation. In addition to that, you've got the point that they expense all their sales and marketing So they spend a lot on sales and marketing. They have done in the past because they're trying to build their market share, and they also capitalize about half their. Actually, it's not all that. They expense 95% of their sales and marketing, and they probably expense about half their research and development and capitalize the other half. Mm-hmm. So, and these are all timing differences. That expenditure. The idea of accounting is that you try to match your expenditure to the profits, to the revenue that expenditure was designed to achieve. So. That's why people capitalize things, because they expect to get revenue from them years into the future. And part of the sales and marketing that Xero does is to replace lost subscribers each year. Part of it is to grow the business specifically that year with direct sales and marketing. Part of it is to build the brand so that it can sell more in 5 years' time. So, and that latter bit would be appropriate to capitalize. But, if you want to get a true picture of the profits. So how you unpick all of that is adds another level of uncertainty to the valuation.
It does seem as though if you're looking at Xero and then comparing it with TechnologyOne and Altium, that the path forward for Xero has more uncertainty than it does with the other two.
Yeah, I'd say much more. I'd say Xero, much more uncertainty. Altium sort of in the middle because it's got this huge opportunity which it may or may not achieve, but it's really the only one playing for it at the moment, or at least it's a long way ahead of the others. And then you got TechOne, which just has a roadmap in front of it, and it's just plodding along, just same as it always has. And really, that consistency and 15% growth is really quite remarkable. It's been doing it for 20 years and no reason it shouldn't keep going with it. The reason I put the valuation in the Xero article last month is really, so I barely even call it a valuation because really it helps to put some numbers around things so you get an idea. It gets you to think about what the future might look like for this company.
Yeah, that's how I used it. And that's what made me think that, well, if I was looking at these three together, there does seem to be more uncertainty attached to Xero's future and how it might play out than the other two. Offsetting that is but the possibility that it might well conquer the UK. It might do okay in the US. And if those two things happen, then you could see pretty good revenue growth over the next 4 or 5 years. That would take you to a decent kind of return from this business. But that it's a question mark over it, whether it can do that, especially in the US, that causes all of these fluctuations.
Yeah, that's right. In the three scenarios I set out, and I forget what the revenue growth I had in the bear scenario, it might have been 15%.
15%, I think, yeah.
Yeah, and then 20, and then 25, it might have been. And so, look, there are plenty of people that say that 15% was quite optimistic for the next 10 years. But look, it's been growing way faster than that in the past. So, but look, in that scenario, I think you probably break even over 10 years or get a 0% return. So it's a lost opportunity. 0% over 10 years is a pretty bad result. I reckon in the middling sort of scenario, if 20% revenue growth, you'd probably be looking at more like 10% a year. And then you'd be up in the high teens if you got the 25% a year. But I think that's quite unlikely. I think that I think you're more likely between the bearish and the neutral scenario, somewhere around there. So which that's at around. Well, actually, that was at $100. So things look a bit better at $85. But we need something, I think, below $80, and then I've got to convince everyone else. And I think that's a struggle. Well, no, it's not that. I mean, look, quite reasonably. I mean, we're value investors, right? So we need to see a margin of safety. We need to, and it's very hard. Look, in TechOne, I can see a margin of safety. The valuations, it's fairly clean sort of thing. It just depends. I suppose with TechnologyOne, it depends how long you want to extrapolate that 15% a year growth. With Altium, again, but there's that you can see the growth, you can see the valuation. But with Xero, very hard to see a margin of safety, and so we do need a pretty cheap price to get us over the line. And if we never get over the line and it conquers America and it does brilliantly well, then hats off to it. And you don't have to be in every stock that goes up to do well. You just have to be. Pick a few where you think you've got a good margin of safety and an attractive returns.
All right, so that covers our technology businesses in the list of the top 10.
Well, we got Audinate.
We do have Audinate, which we're going to talk about next week. But that's kind of different because it is a manufacturing business as well, in a sense. But it's software based.
Well, it's software. It is software, but it's a different kind of thing. Yeah.
So they're the three that we've covered off. Thanks a lot for your time, James. I hope that gives members a good insight into these businesses. With Xero especially, we recommend you go back and listen to our conversation about the company in more detail from the last Stock Take podcast. But for now, thanks very much, James, for going over those things, those businesses. Pleasure. And we'll speak again when we cover 3 more of your stocks on the top 10 list of growth businesses.
Can't wait.
Thanks, James.